Welcome to the Commercial Real Estate Report. Today we're talking retail real estate with a good friend of mine. I'll introduce him in a moment. I'm your host, Chris Berg, head of business development for Abernathy Holdings. We build Class A self-storage sites in Arizona and California. Joining us today, Scott Tiano. He is a managing partner, principal at Hyperion Realty Capital. Scott, it's great to have you with us, and thanks for giving us some time.
Chris, thank you. It's a wonderful thing to be, interviewed by one of the greats in the world.
I appreciate that. And speaking about the greats, I just want to introduce you, and then I'm going to run down some of your stats. 20 years almost in the business. Hyperion, according to your website, $3.5 billion in real estate transactions, 1 million square feet under management, over $1 billion of assets under management. I mean, it's a really impressive resume. And so I just love for you to share with our audience, some of your background, but also you and I were just talking before this, some of the headwinds that you see facing grocery anchored shopping centers and just retail real estate as a whole.
Yeah. I mean, one of the through lines that you'll hear me say time and time again, whether it's, talking about personal issues or business, is that it takes a village. And I'm a firm believer in that. And interestingly enough, I feel like, all the years that it's taken to get to, call it cruising altitude, which feels like there's still a ceiling, a big ceiling ahead. You have to prove that you can do it on your own. And so, if you're asking me to describe my background in a nutshell, it was one where, I went from producing movies to doing international consumer products trade to doing licensing. And then one day I woke up and I said, it's time to grow up. I want to be a big boy. I want to go do some commercial real estate. And, from there, I kind of did a lot of it on my own in many ways, although it takes so many great people that I could list for hours that have helped me get here. And I'll be very real and very humble and say that there's no way I could have done this without, the help. And so yeah, I mean, we're busy. We've been very busy the last few years. My partner and I, we started our first fund a couple of years ago. It was supposed to be a $50 million fund. It ended up being an $80 million fund because people woke up and said, wow, this grocery anchored retail space, this niche that has been kind of the redheaded stepchild for so long, with the internet eating its lunch and with all of the the pandemic and all this stuff. Well, it turns out it's an incredibly resilient sliver of the greater commercial real estate space, and we're riding the wave. We're grateful to finally be here because we've been doing this for so long, watching our friends in multifamily just get richer and richer and richer because the tide has been rising like crazy. And we're sitting there, continuing to make our relationships with the Krogers of the world and the Starbucks, but, not really being able to monetize it. And now it feels like, and maybe it's just the microcosm that I work within, but there are returns and then there are risk adjusted returns. And the risk is really where we focus a lot of our mindset and our strategy, because anyone can go ahead and promise 15 IRRs to an investor, but at what risk? It's not talked about because you can't. There's not like a metric. There's not like a unit that denotes what is the level of risk. Of course, cap rates are a function of risk, and of course, there are various telltale signs. But we're really looking at every deal today in a way that talks about defense first, and then how to get to, those IRRs. As you know, I don't have to tell you, people aren't transacting right now. They're just on the sidelines. They're waiting for all this distress to fall upon us. In the meantime, I'd say of my 300 or so investors, there's a good 25% of them that are, as a term you mentioned earlier, dollar cost averaging into the market, because there's a tremendous amount of confusion and there is a tremendous amount of capital on the sidelines. So you have to remember, as much distress as there might be out there, there's still a lot of capital that's going to push those prices, to a higher number than most buyers would probably, hope.
You just packed so much into that. I want to sort of unravel some of it piece by piece. And you talked about the resiliency of your asset class, the grocery anchored shopping centers. And it's perfect time to have you on. If you remember, you and I spoke a while back and the Wall Street Journal came out and said, hey, and I know there's a distinction here in asset class, but strip malls are the new El Rey, right? The king of real estate right now, right?
Right.
And then just this morning, I want to share this with you because I'm sure you've seen some of the news coming out about multifamily. You said, hey, all my multifamily buddies were making all this dough, but now people are scattering even out of Texas in multifamily. I saw in Austin, the guys behind on a loan. And good news for you, in 2023, the asset class that had the least amount of reduction in value was retail. And I say all this because I think it surprises some people. You talked about the resiliency, how hard you've been working. But I think there was a time when everyone thought, oh man, Amazon's just going to wipe out retail. You might as well just get rid of the asset class. And here I was on a Marcus and Millichap webinar recently, and they talked about the strength in the class. So just why do you think it's been so resilient, and where do you see things headed with technology and Amazon and all things that are happening?
Yeah. I do appreciate the slide. The problem with that slide is that retail sliver should be segmented into 5 different slivers, really, because when people talk about retail, they're talking about enclosed malls, they're talking about unanchored strip, they're talking about single tenant triple net, they're talking about grocery anchor, talking about promotional. There's so many levels of retail, and that is primarily the reason why we have done so well, is because the headlines are comprised of all those 5 segments except for the grocery anchored stuff. So everyone sees, like you mentioned, the enclosed malls. You look at okay, I'm not going to go and talk about every single thing, because now the words are coming out of my mouth. Single tenant triple net retail has actually done very well as well. There's some strip that has done very well, but by and large, what the big trend that we've analyzed is the difference between durable and non-durable pricing and volume. And what I mean by durable and non-durable is, as you've seen over the last couple decades, there's been an evolution in the convenience sector of retail, the grocery anchored, the strip, from goods that can be bought online and that I would call durable, to non-durables, which are services and other kind of short-term items. So what you're seeing is, on the non-durable side, pricing has gone like this, volume has gone like this, and on the durable side, it's like this. It's really an incredible trajectory. So whether it's medical backfilling a former furniture store, or some other operator that takes up the elbow space, or it's fast food going into a pad that didn't have a drive-through, but now it was entitled for a drive-through, or it is nail salon, pizza, just go on down the line. These are all durables, and these are all service oriented. And that has proved incredibly resilient through the pandemic and in the face of an e-commerce boom that will keep going and keep being a benefit to bricks and mortar retail, frankly.
So what are some of the things that you're looking at into the future, say 3, 5, 10 years down the road, going, okay, these are things we need to be aware of to try to get ahead of the curve on those items?
Yeah, it's a good question. Right now, convenience and pricing are the big things that are running through my mind. On the convenience side, the trends are going to continue to be that we have less and less time. There's more and more demands on our time, and we need to get in and get out and get back to our families, get back to our lives, get back to whatever it is that we choose to do when we're not working. On the pricing side, there's plenty of stats that I could point you to, whether it's Walmart sales versus Target sales over the last year, or just looking at some of the other data pointing to the sensitivity of shoppers right now. When during the holidays, you had Black Friday and Cyber Monday, and you're seeing that we've done very well when it comes to discounts. Shoppers are shopping, even though all that money they got during the the PPP money and all that that gift from the government, it is starting to run out. They're shopping. They're just more sensitive, and they need discounts. So that's what you're seeing.
Yeah, I think speaking of that, I think there was records of buy now, pay later sales as well that took place over that weekend. So you can tell that people's budgets are definitely are tightening. So you mentioned your list of 300 investors and the capital on the sidelines. What are you hearing from them? What are they waiting for? Like, talk to us about some of those conversations you're having and what they want.
Yeah, I mean, look, the REITs are paying through the nose still for grocery anchored retail. The institutions are looking at their allocations and they're saying, wow, we are really under allocated to retail. We haven't bought retail in so long. What should we be doing? Well, the retail per capita today is less than it's been in 40 years. There has been such an underdevelopment of retail, which is the fundamental reason why that graph you showed, those charts is what it is, because they're just, there hasn't been a lot of new development. Hence, leasing it's more scarce. There's less spaces to go after, and when we look at opportunities, and I'm talking to my investors about opportunities, I'm really talking about the intrinsic value of the real estate. I'm not talking about the credit of a Starbucks over a Raising Cane's or a CBD store that's paying through the roof versus a Chick-fil-A. I'm talking about if it's neither of those, if they go bye-bye, why is this intersection more valuable than the one across the street? And there's a lot of reasons, and there's a lot of data that we have that allow us to synthesize what we do as real estate guys, which no technology can ever surmount. But there's also a need to utilize things like Placer and ESRI and all of this, the demographic information that we have. So to answer your question, because I never answered your question, the conversation with my investors is really, my true feeling that if we could take the debt markets out and we could buy all cash right now, grocery anchored at 7.5 caps all day long, because historically they're trading at 5.5, 6 caps. So why not buy them now? You're still getting a great deal. And it's still a great return. And when debt markets come back to normalcy, then we can refi or finance, because we didn't put any debt on it. So I think there's strategy there, but like I said, only about 25% of my investors are excited about making investments right now. That number's going up though.
It is. How come?
Yeah. I think it's been a year and people have kind of been waiting, and they're seeing, 5% in the treasuries. That's fine. But, the treasuries were at over 5% a month ago, and now they're at 4.3. Like, that's not going to last forever. And if you have more of a long-term mindset, which most real estate investors do, they should be open to the story. They should be open to a deal, because that's how you make your money on the buy. And where there's distress, there's going to be a buy, and there's still distress now.
I want to talk to that, but I think what's interesting is there's so many ways to conflate and confuse real estate, especially investments, right? And yet, not to put words in your mouth, but what I heard you say essentially, Chris, is look, the reason we feel like we've got great assets, it's the old saying, location, location, location. Is that a fair assessment?
Totally.
Yeah. So when you sort of break it down to that simple premise, it's like, okay, this game can be fairly simple. But you also mentioned multifamily a little bit ago. I'm assuming as you're talking to your investors, look, they can put their money anywhere, right? They're looking at different asset classes. What's your pitch or your thesis to say, this is why you should give me this capital, rather than, multifamily is having its challenges right now, but I'm in self-storage, great asset class over long term. So why your asset versus something else?
I think there's, number one, that this is the only asset class that I know of right now that you can still get positive leverage, even in this environment. But things have changed, but they really haven't changed that much. We're always going to need grocers. They're not going anywhere. And when you think about the evolution of population growth out of the CBDs into the valleys, into the suburbs, people wanted more space. They wanted, to have, it was affordable. They could raise a family there. This is in the 60s and the 70s. This is when all those groceries were popping up all over the place. And those grocery stores were signing, maybe it was a 10, 15-year initial term, but then they'd have 8 5-year options. So you add, the 40 years on top of the 10, and oh my God, we're like right about now. So what we're seeing is the ability to find grocery anchored product where the grocer rents are so low. And you put that on top of our thesis, which if we can backfill, if Armageddon happened, Instacart became the new Kroger, and Kroger was decimated, and there's no grocer that anyone goes to, as long as it could be a last mile fulfillment center, that's okay. What are those rents? What are those industrial rents? And we're finding that we can pick up a grocery anchored deal where the grocer's paying $8, $7, $10 a foot in rent. We'll do that all day long, as they're doing decent sales. So the stability is there, the resiliency is there. If you're still standing after the pandemic and the e-commerce evolution, I don't care if you're a mom and pop nail salon who has to make that money to support your family and possibly others. Like you're not going anywhere unless something crazy happens. So I think there's a lot more resilience in that sector than people recognize.
You may not want to answer this, but I appreciate your transparency today. So you talked about the resiliency, the lack of development that's happened over the last 40 years. There's a lot of smart money out there. Do you think you're going to see an uptick in development now or soon? Because that's where there's some alpha.
In ground up development, you're saying?
Yeah.
Man, if you could develop now, I mean, you'd be sitting pretty. I mean, because there's going to be no product. There's going to be no new product in a couple of years when you're done. And I think the supply demand continuum would be very much in your favor. I am developing something right now, so maybe I'm touting my own cause, but no, I think ground up development for a single tenant triple net. I mean, we do that all day long. We're building a Starbucks right now. We think that market's not going anywhere, and it's going to be around for a long time. But what I develop, multifamily right now. I mean, look.
What I meant specifically, you said the development's been so low in retail. So like grocery anchored shopping centers like you guys focus on, or this retail space, do you think there's going to be a lot more,
a lot more of that
institutional type money coming into this space? Because they're like, wait a second, this is where I can see some alpha. Multifamily right now is, I mean, I saw a stat the other day in Miami where there's more multifamily coming on board like in the next 3 to 5 years than is currently in the city. I mean, it just, the supply is going to be so high soon. And Miami's growing like a weed, but just as a small example where you're saying, hey, Chris, there's been so little development in this retail space for so long. It just seems like there could be an opportunity. What say you?
Yeah. I think there are, and I think there will be. There's a lot. I mean, it's almost like what happened back in the 70s with a move away from the CBDs. We're seeing a lot of demand crop up, not necessarily in Seattle, but in Puyallup or in Marysville, not necessarily in Phoenix, but in Tucson, not necessarily in, I mean, maybe not Denver, but it's, some of the surrounding areas around Boulder, or there's just there is a trend, and it's probably having to do with the work situation and people not having to go into the office as much, even though we're seeing that trend, back to normalcy a little bit right now. But there is going to be some new, retail follows rooftops. So, as that happens, we're going to see more retail. But you're not going to see more retail development in the mature areas. You're going to see an evolution of the collateral that's sitting on this great intrinsic piece of land. So that we'll see. We'll always see.
I'm excited to see too, kind of how it transforms and how it changes. I want to be respectful of your time. Just a couple more quick questions, if you will. I know you've got a new syndication platform. Like, tell us how that works and how you're using that.
Yeah, I mean, it's not super new, but it's what we found is, in our managing of the funds, we're leaving a lot of our relationships unsatisfied because not everybody wants to invest in a fund. There's great reasons to invest in funds. We found 80 million of them recently, and we're en route to finding 200 million more for Fund 2, which we just launched. But for those that want to come into a single asset that they can kind of make a bet on, and have more of a defined strategy, we from time to time will have a grocery anchored opportunity, but we're on the single, syndicated deals. I think we're going to find more strip retail opportunities, but either way, they will have a story. And we know retail, and there's great retail. I can't see us buying enclosed malls because that really means we're developers. I don't see us buying big box promotional centers because it's just those are too risky for us, even though great cash flow and the numbers look good, just too risky. But there's some great corners still that have tenants that really could be upgraded and we can still create value there. So yeah.
Last question for you. So as you think about your business and you're looking out over the horizon, There's conversations about where rates are going. You've talked about, some of the development in your arena. When you look at all the different variables, what right now keeps you up at night in regards to your business?
That's a great question. I mean, we really are operators. We're not just allocators. I mean, a lot of fund managers come from institutional backgrounds where they're not necessarily in the trenches, like really fighting. And, coming kind of full circle to it takes a village. I go back to, my start where I was doing absolutely everything. I was doing acquisitions. I was doing fundraising. I was doing legal review. I was doing investor relations. Leasing, everything. Today, although we have an infrastructure of really great people, what keeps me up at night is absolutely everything, because now we have to run a business, and it's not just staying in touch with the real estate, which we have to. It is. I can't be in this business without touching and feeling and really understanding the tenant makeup, the traffic patterns, the evolving needs of the community. But we've got a great staff. So what keeps me up at night? I don't want to lose these guys. I hope they're not listening to this, because they're going to know they have some leverage. But I'm not too worried. We're bonusing everyone this year, even though we didn't make a dime. I'm not going to say that, but it's been a slow year, and we are taking care of our people. That's what keeps me up at night, is making sure our people are satisfied and fulfilled.
Nice. Yeah. Again, man, thanks for the time. I just want to give you the last word. And for people that want to get a hold of you, how can they do that if they want to invest or just find out more about you?
Oh, thanks. My email is stiano@Hyperion CRE. My phone number is 310-413-8109. Or they can contact you and you can put them in touch with me. But open door. I want to keep the village expanding, and not just with quantity, but with quality. And you are part of that, Chris. So thank you. Really appreciate you having me today.
Thank you. I really appreciate you taking the time. It's been great to get to know you and just watch your continued success and how you see the business and what's happening here in the future. So I hope we can do this again. Okay.
Anytime. Let's go.
Thank you, Scott. Appreciate it.
Have a great one.